Let's take a look at exercise 13-4, parts A through E. Now in this one we're preparing journal entries related to shareholders' equity, so we're concerned with shares of stock. We've got the Marigold Corporation and they issued 3,650 shares of stock, and we have to prepare the journal entries. Okay, so part A says the stock had a par value of $6 per share and was issued for a total price of $54,000. All right, so what's our debit and our credit? Well, our debit is to cash, the amount we received, $54,000. We're going to have a credit of common stock, $21,900. How'd we come up with that? Right there you can see 3,650 shares given here times the $6 par value. Okay, and then the difference would flow through as a credit to paid in capital in excess of par on common stock. Part B says the stock, what if, another case, the stock had a stated value of $6 per share and was issued for $54,000. So again, we got a debit, a cash, $54,000. Now we've got a stated value of $6, so it's the same amount, the $21,900, calculated the same way, $6 times 3,650. That flows through to common stock, but now the account we would use to show the difference between the par value and the full value of the proceeds we received goes to paid in capital in excess of stated value on common stock. Okay? All right, then C says the stock had no par or stated value and was issued for $54,000. Well, in that case, we simply debit cash for $54,000 and credit common stock for the same dollar amount. Okay? That's the proper treatment when there's no par value or no stated cash value. All right, what about Part D? Part D says the stock had a par value of $6 per share and was issued to attorneys for services valued at $54,000. Well, this time we're not receiving cash. Instead, the attorneys helped us during the incorporation, so that would be recorded as an expense, organization expense, $54,000, and the credit would go at the par value of $21,900. And then the difference flows through as paid in capital in excess of par on common stock. Okay, and then the last case, Part E, says the stock had a par value of $6 and was issued for land worth $54,000. So no surprise here, you're going to see land being debited for $54,000, and if I move this down, you're going to see the usual case of what we expected, right? Which was a credit to common stock of $21,900. We know where that came from, calculated right there, and the difference is in paid in capital in excess of par on common stock. Okay, I'll slide back up to the top, and that's this problem, everyone. I hope you found that helpful.